Welcome to the Tax and Interest PowerPoint audio presentation. Do you have what it takes to be a millionaire? Perhaps you do and just don't know it yet. You don't need to invent the next wildly distracting electronic gadget. You don't need to work 24/7, 365. You don't even need to earn $100,000 a year, although that would be helpful. You just need to do 3 simple things. First, make your money work as hard for you as you do for it. This is called efficient application of the Rule of 72. Second, protect your money against market risk. This is called avoidance of market losses. Third, protect your money against income taxation. This is called avoidance of taxation. Naturally, you need to save or set aside some of your money in order to earn interest and make your money work as hard for you as you do for it. However, with the help of this course, you will be able to set aside money without doing so out of your own pocket or changing your lifestyle or your economic status. This course demonstrates how to keep more of your earnings by lawfully protecting yourself from excess taxation and earning the best available interest without taking risks in the market. To make your money work as hard for you as you do for it, you need to earn the best available rate of interest. To do so, you need to understand and apply the Rule of 72. 72 divided by the applicable rate of interest equals the approximate number of years it takes for the value of your money to double. For example, 72 divided by 10% interest equals approximately 7.2 years for your money to double. The rate of interest represents how hard your money works for you and indicates the number of times your money doubles in size in 72 years. Naturally, the more years you have, the more interest you earn, and the more times your money doubles. Obviously, procrastination is devastating to your financial prosperity since it only reduces the number of years you have and diminishes your ability to accumulate wealth. To protect your money against market risk, you need to participate only in market gains, not losses. This chart illustrates the 2 categories of interest-bearing vehicles and the associated variety of potential interest rates. Since they generally are risk-free, fixed vehicles are considered safe, but they perform poorly, whereas variable vehicles have the potential to perform very well, but at great risk of loss in the market. Available since the mid-90s, index vehicles are considered fixed since their cash values are not actually invested in the market and are thus protected against risk of market losses. But they do enjoy great potential since, by design, their cash values participate only in the growth of the market. To protect your money against income taxation, you need to use only tax-free vehicles. Taxation diminishes both present and future value of your money, as well as the size of your future distributions from your money. Tax-deferred vehicles reduce taxation, theoretically, but do not eliminate taxation, and are subject to early and late distribution tax penalties and minimum distribution requirements. Used properly, tax-free vehicles avoid taxation completely. All categories of retirement vehicles offered by financial institutions are based on sections of law in the Internal Revenue Code. Nearly all categories are tax-deferred in nature, meaning that amounts contributed are not taxed until they are received as retirement distributions. The theory behind tax-deferred retirement vehicles is that workers generally pay taxes at higher rates and retirees generally pay taxes at lower rates, so that tax costs on retirement distributions are lower than tax costs on gross earnings not contributed to tax-deferred retirement vehicles. The actual amount of tax paid on the same money is less in retirement. However, tax costs on retirement distributions are actually higher for taxpayers that find ways to increase career and retirement income. The actual amount of tax paid on the same money is more in retirement. Moreover, Heavy restrictions, non-compliance penalties, and low real growth potential make tax-deferred retirement vehicles unattractive. To illustrate, let's apply all of this to your monthly budget. Please open the tax and interest spreadsheet workbook accompanying this presentation and begin filling in all the green boxes with your own information as the presentation proceeds. Click on tab 13 of the spreadsheet for the monthly budget worksheet. Without a plan, you will pay both taxes and interest to the government. With a plan, you can keep most of your money rather than lose it. Why is it important to keep it? Because you can make your money work for you instead of against you. On tab 13 of the spreadsheet, the monthly budget worksheet, fill in the green boxes for wage rates and hours worked each week for yourself and your spouse, for sole proprietorship and or partnership business profits per month, and for S corporation business profits per month. If you earn a salary, enter the salary amount divided by the number of hours worked for the wage rate, and enter the same number of hours per week. Also fill in the green boxes for your filing status, based on one of the 5 statuses listed below the box, and your monthly expenses: the total amount you pay for your residence plus utilities, the total amount you pay for vehicle loans and other transportation, the total amount you pay for all types of insurance, and the total amount you pay for groceries, restaurants, clothing, and entertainment. Be sure to fill in all information correctly for accurate calculations. The worksheet will calculate an estimate of your current annual earnings-based taxes and arrive at an amount of interest that fits into your monthly budget. Most people find a way to squeeze this extra expense into their budgets using credit cards, getting new car loans shortly after paying off old car loans, and refinancing and refinancing and refinancing their homes. Click on tab 14 of the spreadsheet for the credit card spending schedule worksheet. Credit card spending schedule. Most people spend interest on credit cards without thinking, and this is very costly. Some credit is necessary, so why should the amount of interest you spend concern you? Because maintaining revolving credit of just $10,000 from age 18 to age 65 could cost you a fortune in interest, which, turned into income instead of expense, could make you extra money each month for retirement. Both the interest spent and the extra income each month could be yours. Besides, why be enslaved to working just to pay taxes plus interest on debt? Moreover, do you want to pay the government for taxes and interest unnecessarily? On tab 14 of the spreadsheet, the credit card spending schedule worksheet, fill in the green boxes for either your current total credit limit or the total of your current actual credit card balances, as well as your current age and the age at which you want to retire. Be sure to fill in all information correctly for accurate calculations. The worksheet will calculate an estimate of your credit card interest. Don't be concerned with the interest rate. The first point here is that you could spend a fortune in interest on revolving credit, even if you have earned a good credit rating and a low rate of interest. The second point here is that you could be earning interest rather than spending it, making your money work for you rather than against you. The third point here is that you can earn a higher rate of interest than the rate of interest you pay. Click on tab 15 of the spreadsheet for the monthly savings schedule worksheet. Monthly savings schedule. Accumulating savings and keeping interest qualifies you for reduced interest financing for necessities. On tab 15 of the spreadsheet, the monthly savings schedule worksheet, fill in the green boxes for your savings budget, the amount of money you can set aside each month for earning interest, and the rate of interest you expect to earn. Or you can simply leave the suggested 10% in the interest box. The worksheet will calculate your total investment from now as well as estimates of interest earned, account values at 5, 10, 15, 20, 25, and 30 years and at retirement, and projected monthly income from interest only, as well as from full distribution to age 100. Naturally, the closer you are to the age at which you want to retire, the more you will need to set aside, and the more you will need to take advantage of the best available interest rate. This course is designed to help you do both. Click on tab 16 of the spreadsheet for the Mortgage Schedule worksheet. Mortgage Schedule. Notice what reducing your rate by just 1% can do for your mortgage. Most people assume they can never earn more interest than they spend, and without trying, they never will. However, as this presentation has illustrated, it is possible to earn a high rate of interest and spend only a low rate of interest. On tab 16 of the spreadsheet, the Mortgage Schedule worksheet, fill in the green boxes for the principal amount and total number of periods for your largest mortgage, as well as your current interest rate. The total number of periods is the total number of months, or 12 times the number of years of the mortgage. Be sure to fill in all information correctly for accurate calculations. The worksheet will calculate an estimate of the total interest on your current mortgage and an estimate of the total interest after reducing your interest rate by just 1%. The worksheet will also calculate an estimate of your total savings as well as extra monthly retirement income you could realize with the rate of interest you indicated on tab 15, the Monthly Savings Schedule worksheet. Don't be concerned with any additional mortgages you may have. The point here is that you could convert some of your mortgage interest expense into interest-bearing savings and extra monthly retirement income. Here again, making your money work for you rather than against you. Save the spreadsheet workbook under a new name for your current calculations. Keep the workbook open, and then click on tab 17 of the spreadsheet, Brief Comparison of Annuities, Life Insurance, and Direct Investing. All three provide an opportunity for the best available and highest possible rates of interest and guaranteed growth. Annuities may be subject to taxation and/or contribution restrictions. Life insurance provides an umbrella of protection beyond the cash value of the associated account, but is subject to customizable contribution restrictions. Direct investing is subject to either inflation risk if low interest-bearing tax-free vehicles are used, or market losses and annual taxation if high interest-bearing vehicles are used. Click on tab 18 of the spreadsheet, Strategy. People tend to live with the single goal of making as much money as possible without seriously considering other factors that significantly diminish their wealth and income generating potential. This course is designed to help you develop and implement a strategy that addresses all 8 of these points and accordingly help yourself capitalize on your wealth and income generating potential. Summary. Click on tab 19 of the spreadsheet workbook, the Summary worksheet, to view your projected results. The Summary worksheet displays the calculated amounts for monthly retirement income you could generate in interest on credit card and mortgage interest saved, as well as what additional amounts you set aside each month from taxes saved and other savings plus compound interest on such amounts. You can see that the combined total monthly retirement income is considerable. You can also see that it is imperative that you develop, to the greatest extent possible, all 3 categories of monthly retirement income. Schedule of lawful annual diversion of income tax costs to permanently tax-free compound interest-bearing wealth. Click on tab 20 of the spreadsheet workbook to view your potential. This final page in this presentation illustrates the wonderful results of observing all 3 principles in combination for achieving maximum possible financial prosperity. First, using the best available interest rate via an index strategy achieves efficient application of the Rule of 72 by making your money work as hard for you as you do for it. Second, using the best available interest rate via an index strategy also achieves avoidance of market losses by protecting your money against market risk. Third, using tax-free vehicles achieves avoidance of taxation by protecting your money against income taxation.